Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And thank you to all my loyal listeners. I appreciate you tuning in every week. Just a reminder, if you want to leave a rating where you're listening to this podcast or share this episode or other episodes with anyone you think might benefit from listening to it. Of course, I'd be greatly appreciative of that. Put a lot of effort into these podcasts. I hope it comes across. And the more people that it potentially helps, the better I'll feel about that effort. So that's something that you could do and it'll be greatly appreciated by me. Anyway, let's get into some questions. I'm determined to get through a heap of questions between now and the end of this calendar year. So let's get into it. The first one is from Anita. Anita writes, my question is, I plan to sell my principal place of residence, which is almost debt-free and worth $650,000, and move in to my investment property, saving capital gains tax and freeing up money to build a share portfolio so I can reduce my working hours to care for my son as a solo parent. Does my investment property stop being tax deductible as soon as I move into it? Yes, Anita. As soon as that property is no longer available for let, which means that the existing tenant exits that property and you don't advertise it for, rent, of course, any expenses, including interest and so forth, stop being tax deductible from that point in time. If they're point in time expenses like interest, of course, any interest from the day after it becomes available or stops being available for let. Any interest beyond that date is obviously not tax deductible. If they're fixed sort of bills like, say, council rates, for instance, you would just apportion it throughout that tax year. Again, the number of days it was either let or available for let versus 365, that proportion would continue to be tax deductible. Of course, you can claim the main residence exemption after you occupy what is now your investment property. And the way that will work is it will be apportioned by the number of days you've owned that property versus the number of days you've occupied that property. So you won't obviously get a full main resident exemption for the entire ownership period, of course, because it was an investment property. But the longer you live in it, the more you dilute potential capital gains tax consequences. And so that means that if you've owned the property, say, for 5 years, and then you occupy it for, say, 15 years, well, 75% of the capital gain that you eventually make on that property will be tax-free. That's how that will work, Anita. Of course, I should remind listeners, this is not personal advice or tax advice. I may or may not know all the relevant information I need to at least tell you what the consequences will be. Just broadly, those rules are correct, but how those rules apply to individual circumstances is something you're going to need to work out for yourselves. Okay, next question is from Chris. Chris writes, really enjoying the podcast. My question relates to using equity in my home to purchase shares. I've been doing this for 25 years. It served me well financially and I've enjoyed being connected to financial markets and global affairs. The interest is tax deductible. My current portfolio is well diversified, with the bulk of it being in international Australian ETFs, half of them generating healthy franking credits. The current value is $320,000 and the outstanding loan is $300,000. I'm now retired and find myself in a lower tax bracket, 16% compared to the 37% when I was working. Thus, I wonder if it's time to sell the shares and pay out the loan, I should say. What are your thoughts? Well, my first thought, Chris, is if you've been doing it for 25 years, why is the portfolio worth $320,000 and the loan is worth $300,000, which means you've only got $20,000 of equity or capital gain potentially? Now, you may have sold some of those shares that you previously purchased. If you have sold some that you previously purchased, you probably should have reduced the loan amount as well. If those parcels were originally funded by the loan, and you want to be careful there because if the ATO did an audit, they would say, well, you haven't at least used the sale proceeds to reduce the loan. If you've been doing it for 25 years and your capital gain is only $20,000, then we've probably got a bigger question to answer here, Chris. But I don't know the circumstances, of course, and I don't mean to judge, but that's just an observation. If you've got $320,000 invested across both international and Australian shares, I get that the Aussie ETFs will give you a reasonable dividend yield and some invitation credits. But if it's that highly geared, I imagine that the total investment income will be less than the interest expense, which I think is what you're getting at in terms of the tax benefit associated with that negative gearing doesn't make sense. But also putting tax consequences aside, it also probably doesn't suit your age and stage of living as well. Like if you're retired, you don't really want a portfolio that's negative cash flow that's taking money out of your pocket. That's a little too aggressive for someone that's in retirement. That's probably fine for someone that's in their 20s, 30s, or even 40s. But someone that's retired, it's no longer appropriate. I'm happy to use gearing in a portfolio. And look, sometimes we gear 100%. And the only time we would do that, or at least 99% of the times we would do that, is where the client does have a lot of surplus cash flow, but we tell the client, no, you know what, put that in your home loan and we'll borrow, if they've got, say, $1,000 a month, $5,000 a month, whatever it is, we would say instead of putting that $5,000 a month into the share market, why don't you put that $5,000 into your non-tax deductible home loan and we'll go and borrow $5,000 a month to invest in shares. So that situation where we're significantly or aggressively reducing debt is the only situation where I tend to be comfortable gearing a share portfolio to 100%. If we're not doing that, quite often what we would do is just gear at 50. So we'd say to the client, okay, you're going to invest $5,000 a month. We're going to borrow $5,000 a month and we're going to invest $10,000 in total in the share market. And that way you're ending up with a really conservative gearing level that is, it might be still a little bit negative cash flow depending on the asset allocation, but it's not going to be wildly so. And in that situation, if we ever want to stop or adjust, because one of the benefits with shares have over property is it's quite flexible, and that's a pro and con, by the way, because, at least property forces you into investing each year. And that can be a positive too. But anyway, with share investing, at least we can dial it up or down. We can stop it, we can pause it. We hope we don't. And the discipline of regular investing is critical. But we do have that flexibility. Whereas if you gear to such a high extent, you start losing that flexibility because then you've got to sell down. So coming back to your question, Chris, yes, I think it probably is time to reduce your investment debt. You might not necessarily reduce it to nil. You might be quite comfortable to carry some level of debt, but I would say substantially less than what you've got at the moment. Maybe, I don't know the rest of your circumstances, but maybe somewhere a lot less than 100,000. So you want to probably reduce your exposure as much as possible. Okay, next question is from Alex. Alex writes, my name is Alex, and first of all, I'd like to say how much I enjoy the podcast. My mum is a much longer term listener, kept recommending episodes for me, and after a few, I didn't look back, and I'm an avid listener now. Good on you, Mum. That's really good. That's why I sort of said at the beginning, if you can share it, it's fantastic. I hope it doesn't sound too arrogant, but, if we can share a couple of tips that are going to help people along the way, I think it's great. Anyway, getting back to Alex's question. My question for you is whether a unit with some backyard space would be considered a good property with underlying land value. Obviously, it would be more ideal for a property to completely on its own title, but how would you consider a unit with some backyard space on title? Are they still good investment grade assets? Just as a bit of background, I'm 20 at the moment and I'm looking to get into the property market in the next 12 months or so. My long-term plan is to get a unit type property in the next 12 months and then pay the mortgage off over the following 10 years and hopefully use the equity in that property to buy a long-term property for me as an owner occupier and make this unit as an investment property. I'm going to come back to that in a second. Alex continues to write, by buying the unit first, the plan is to take advantage of the various first-home buyer schemes, which are often limited in terms of the maximum purchase price that you can spend on them before buying a longer-term property with these first-home buyer type schemes wouldn't be available. However, with this price limit on first-home buyer schemes, units are more in my current price range in better suburbs for investment. So this prompts my questions. Again, thanks for the podcast. Can't wait to hear your answer. Alex, thanks for your question. It's a really good one. Let me circle back to something you didn't ask about, but you mentioned, I don't know if you meant to say this, but you said that you'd like to buy this unit, repay the loan, use the equity then to buy your forever home. Never, ever, 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 particularly if you're 20 years old, repay a loan. Never. Instead, make sure you set the loan up as interest only and put the money in the offset account. So you can notionally repay repay the loan, as in notionally reduce debt and therefore reduce your interest expense, no problem. But don't actually put the money into the loan and reduce the balance. And the reason for that is that once you repay a loan, from a taxation perspective, it's gone forever. You can't re-gear that property and then claim a deduction for the interest in the future when you go and buy your home, because it's the purpose for which you use those funds. So what I'd say to you, first and foremost, go and buy that property. Fantastic. You're 20, which is great. Get into the market as soon as you can. I love what you're saying here. But set the loan up as interest only, put all the money in the offset account. Therefore, in 10 years' time, you'll have a loan that you use for the property, let's call it 500,000, and then hopefully by that stage, maybe 500,000 in the offset account. So ostensibly no net debt, which is kind of where you said you wanted to get. But the benefit then is you can then take that $500,000 out of the offset account and use it as a deposit for your forever home. And you might need to borrow some additional amount using the equity in the existing property as well. But the point is that that original $500,000 tax deductible loan that you use when you first purchase the property then becomes tax deductible when you rent that asset out. And preserving the amount of debt you have against that asset is critical to maximize your future tax benefits. Now, I understand that's not your question, and I'm digressing into something completely different, but it's a really important point, not only for you, Alex, but really for anyone that's buying property. Think very carefully about repaying debt. Unless you're at the end of your journey, which is not the end of life, but end of your asset acquisition journey. I've always been interest only on all my loans. One has now flicked over to principal interest. I probably will take it back to interest only at some point. Just a bit lazy at the moment to do that. But actually, I'm not too bothered if it stays P&I. But most of my loans are on interest only and will continue to be on interest only really for the foreseeable future. But, there might be some point when I'm 70 or something that, I'm quite happy to start paying down debt. Okay, so what Alex is talking about here is either a villa unit. Villa units tend to be, single level, standalone, small houses, if you like. And there might be like 3 in a line on a block with a driveway down the side on a normal or relatively normal residential block of land. And those, as I said, they'll be standalone dwellings and they might have then some little bit of backyard space. Or alternatively, with apartments, typically older style apartments, the apartments on a ground level can sometimes have a little outdoor area. So that again is on title and sort of improves the amenity of the asset. And both these circumstances, they tend to be positive attributes. If you've got a little bit of outdoor area, that tends to increase the appeal of the asset. There's only 2 things you need to really think about in that circumstance: privacy and security. So privacy, sometimes those little outdoor areas, if there's other balconies kind of overlooking that area, or if, the adjoining neighbor has a window, overlooking that area, it can impact privacy. So you want people to be able to use those spaces, want to enjoy, and use those spaces in their own privacy. And then security would be another consideration. So if you were in a block of older style apartments and you were looking at one on the ground floor at the rear and the fence line faced other residential neighbours, that's pretty secure. However, if you were at the front of the block and your little outdoor area, either there's a right of way down the side or, it doesn't provide very good security, that's a concern too. And sometimes, it's going to diminish the value. But really, if you're a first home buyer, I like what you're thinking about, Alex, in terms of buying something with a bit of uniqueness in a good location with a strong land value component. And the only thing I would add there is ability to add value. So try and buy something where, the flooring, kitchen and bathrooms are pretty tired. Maybe they're in original condition. If you can buy that and then over the next 10 years make those improvements, I think that's a good opportunity to build equity in that property. Great question, Alex. Thanks for sending in. Okay, next question is from Yogi Bear. Let's assume that's, it might be someone's real name, I guess. But anyway, Yogi writes, I've been hearing from prominent Australian financial commentators saying that property prices can't keep rising as they've been rising for the last 24 years. But people are still suggesting that if you have surplus cash flow, go and buy an investment property. I'm struggling to understand what's the best way going forward? Looking forward to hearing your opinion. Well, I mean, it's really interesting. Of course, I've been following property for very, very closely, almost, pretty much on a daily basis for coming on 22, 23, probably 24 years now. So, a very long period of time. And people over that last 25 years have been saying property prices can't keep climbing at these rates and at these levels. So that's a common observation or prediction or whatever you want to say. It's a really good question though, because just mathematically, like if property continued to rise by 7% per annum perpetually, at some point, none of us are going to be able to own any property, or at least maybe just unless you're Elon Musk or something, it's going to become quite difficult. So I think it's going to have to level out at some point at a general sort of median price level. It's going to have to level out at some point. Whether that happens in our lifetime or our children's or grandchildren's lifetime, that's a bit of a debate, but it may not be leveling out, anytime soon, possibly. I would reference you back to episode 299, where I compared the last 20 years and the previous 20 years in terms of property price growth in Australia and in capital cities. And I concluded that the last 20 years have been pretty poor in terms of growth, certainly compared to the previous 20 years. I think it was like 5% on average compounding versus 10% on average compounding, so half the growth. So I guess if people are saying that property can't continue to grow, we've got to think about what time period are they really referencing in terms of past growth. Because if you look at the last 20 years, the past growth hasn't been that substantial. Maybe it's sort of 2 or 3% plus inflation, which I think isn't unsustainable. But if it was that previous period of time or the last 40 years, then certainly it's around about 7%, so 5% plus inflation. That's probably not sustainable. If you think about, well, when I discussed in episode 299, I talked about, how borrowing capacity has changed over that time, because there's a lot of commentators and economists talk about household income, and if property prices can't rise higher or faster than household income, which is true, unless borrowing capacity changes. And so in the 80s, 90s and 2000s, borrowing capacity changed substantially over that time period, more than doubled, in some cases tripled. But the last 10 years, certainly since 2017, borrowing capacity has been in strong decline. It's pretty stable now, hasn't really changed for the last year or so, but has certainly declined substantially. Which means that, holding everything constant, like let's assume that borrowing capacity doesn't change, and it certainly won't change, I don't think, like it did throughout the 80s, 90s and 2000s. So assuming the borrowing capacity is static, then property prices have to increase in line with household incomes. And the average sort of wage inflation rate in Australia might be, say, 4-ish%. So really property needs to be growing at sort of 4, maybe 5%. But if you look at the very long term, it can't really exceed that because of affordability. Affordability won't be there. This is more of a macroeconomic discussion, a theoretical discussion. Because, of course, generally, as look at Australia as a general sort of view, but that doesn't really help us make investment decisions, because we've got to look at, okay, of course, there's going to be property that's going to outperform, because that's just the average property. Now, you're going to get some locations like greenfield locations, new development areas, the first release of that land, there's nothing in that suburb. So they sell relatively cheaply. But, 10 years later, that suburb is built out, it's established, it's got a shopping centre, all these sorts of GP, a dentist, all these sorts of amenities. And then you look at the growth rate, the growth rate is pretty significant in terms of property prices, just because it's gone from, a paddock to something that's more established. So you'll get those sorts of situations where you get a bit of short-term growth. Now, that doesn't suit property investors necessarily, unless you're willing to, get in at stage 1 and then sell at stage 3 or 4 or whatever, and only hold for 10 years and trigger tax and capital gains and those sorts of things. Alternatively, what you need to do is invest in property in locations where buyers have other sources of wealth in addition to household income. So that could be business profits, investments, inheritances, employee shares, these sorts of things, where they've got other wealth that helps them afford to pay more and more for that property versus cohort of the economy where they don't have those sources of wealth. It's really just about their PAYG income, and their income's growing at 4% per annum, and that's all it's ever going to do. For those cohort of buyers, their affordability is going to be pretty limited. And so if you're investing in a location where it's dominated or appeals to that cohort, then you're probably not going to experience the sort of growth that might have occurred over the last 40 years, which when you look at the average growth rates of median house prices in capital cities over the last 40, 45 years, you're looking at somewhere between 6.5%, 7% compounding, which is virtually like in the 80s if you invested or bought almost any property regardless of location. Looking back now, you've probably done really well. I don't think that's going to be the case. And it's kind of the thesis or the conclusion that I reached in episode 299. So I know it's a relatively kind of short or basic question you asked there, Yogi, but it's an important one to think about. And when people make comments like property can't keep growing at this level, that's a good macroeconomic observation, but we really need to pull it apart and work out what does that actually really mean for us as investors when I'm looking at buying 14 Smith Street. Is 14 Smith Street a good investment? And does 14 Smith Street really relate to this overall economic commentary? It's important to delineate between, one is a useful economic and socio-economic sort of discussion. The other one is an investment choice, which is a really good segue into the next question by M. I'm going to assume M is obviously just their initial. And answering these questions give me a really good excuse or an example to demonstrate the application of predictions, data, and commentary, and how investors should either use those or in fact completely ignore them. Anyway, let me read out M's question and then I'll answer it. M writes, I'm close to kicking off a pre-approval with your company. I've been told that I'm likely to be able to purchase an investment property for around about $1.6 million. I live in Sydney and would eventually like to own a property in a beachside suburb in Sydney where my husband and I could move into once the kids move out of home. I've got 3 kids aged 12, 9 and 6. That sounds like a busy lifestyle, M. Okay, M continues to write, with that long-term goal in mind, should I invest in an investment-grade apartment in Sydney now, one that we can move into when we become empty nesters, or should I invest in the best asset that I can afford in Melbourne because of the stage of its property cycle? If Melbourne now, how would that set me up to achieve my longer-term goal of being in Sydney by the beach? Also, just because my borrowing capacity allows for it, should I spend that much on one investment now, or is there a better way to plan for multiple investments over time? Noting, though, that I'm 42 and my husband's 44, and I'm guessing there will come a point where banks stop lending to us based on age. Okay, Em, this is a really good question. I'll tell you why. Because I have recorded a few episodes stating that I think Melbourne will generate the greatest dollar value gain from a median house price perspective over the next 10 years. I believe that. I think that's true. And partly that's because of the starting point, right? That Melbourne is, relative to other capital cities, undervalued. So it's sort of starting from that point. But really, we need to think about what are the two assets that we're going to buy instead of just thinking generally about Melbourne versus Sydney and cycles, which is not, I'm not saying ignore that, but let's take it even more granular than that and let's think about the two property assets. Okay, what I'm really comparing is a house in Melbourne, because you've got a $1.6 million budget. That's going to buy you a single-fronted Victorian cottage in a really good suburb. Could be Paran, Flemington, Hawthorne, Brunswick, South Yarra, those sorts of suburbs. For anyone that sort of knows Melbourne, it kind of paints a bit of a picture. But it's a really good quality asset, right? Mostly land value, probably 70% land value. It might only be on a small parcel of land, 250 square meters. Doesn't really matter. It's going to be really high quality land in a high quality location. You're probably going to get maybe 2.5% gross rental yield. That asset has worked very well over the last 40 years. It will continue to work for the next 40 years. It's a great proposition. The alternative is something in Sydney, right? It's an apartment, probably in the eastern suburbs. If you're thinking along the beach, maybe Bondi, Bronte, Tamarama, sort of that sort of location. That's what I'm sort of thinking or visualizing in my head. The key question here is, will you be able to get an apartment with some views? Now, they're not going to be unobstructed views right on the cliff, of course, but will you get some uniqueness there? That's the key thing that I'd like to think about. Because if I could buy an apartment in Sydney and get some uniqueness, so again, I want to see the water because that's the main thing. I mean, the location's fantastic, and those locations, the eastern suburbs I mentioned, fantastic. But I don't want to be looking at a brick wall or a suburban street because then I could be anywhere. So if I could get an apartment with water views in the eastern suburbs, that's what I would do. Because not only do I think it's going to be a tremendous investment because of the uniqueness, but it's also then going to suit your personal circumstances. If I couldn't do that, then I'd buy the house in Melbourne. Now, you ask me, how does it then suit into your sort of strategy? Well, you've already got your home in Sydney. That's assuming that you currently live in a home, you're not renting, because you talked about buying an investment property. You didn't say first property or anything like that. So you've got an exposure to the Sydney market. So I imagine when your kids move out of home and you want to downgrade, you could sell your existing home and then just go buy something where you want to buy. I think what you'd want to try to do now is not put too much weight on these lifestyle considerations for a couple of reasons. The first reason is if you make the best possible decision that you can possibly make today, then you're going to put yourself in the strongest financial position in 10, 15 years' time, whatever it might be. And therefore, being able to execute on your plans and the affordability of that will be easy because you put yourself in a great position. However, if you start compromising or prioritizing some of these lifestyle considerations, it might come at a cost in terms of investment outcomes. And the second point is that, your desires might change. Right. So one thing that I'm always concerned about or keep in the back of my mind is when a client tells me this is what I'd like to happen, my kids are this age, it could be sort of 10, 15 years, probably, or maybe even up to 20 years down the track. I always leave a lot of room, in fact, for the possibility that those goals will change. Now, I'm not going to ignore my clients' communication in terms of what their goals are, but I realize these things might change. So what happens if all your three kids end up living in Melbourne? They go to university in Melbourne, they end up working in Melbourne, for instance, right? You might say, I don't care, Stuart, I'm going to stay in Sydney because I love it and that's where my family is. And that might be the right answer. But, a lot of clients don't really contemplate those sorts of things. And I know that, some clients' plans have changed as a result of, where their kids end up living and working as well. So I wouldn't put too much weight on these goals. Now, if you buy in Melbourne, as I said, you can sell your Sydney home, move to the beaches. If that's not good enough, then you just sell Melbourne and your Sydney home and move to the beaches. But making sure you make the best possible decision, I think, is the right outcome. Now, Em, just circling back, will 1.6 buy you an apartment in those locations that I mentioned with a view? I reckon you're going to struggle. So I probably think you're not going to make less compromises in the Melbourne market than you will in Sydney. But it's interesting, and the reason why I wanted to elaborate on my answer is to help people understand, it's really important to get a good sense of what are the assets, what are the markets I'm buying in is sort of, part of the consideration. But the next step to that is what are the assets I'm buying? I want to compare those two types of assets. Now, easier for me to do because, it's what I've been doing for the last 20 odd years, but it's something that you really want to talk to your financial advisor or buyer's agent about in terms of getting a good sense of what are those assets, what are their attributes, where are they ordered in terms of quality to compare those two different investment options. Great question, Em. Thanks for submitting it. And thanks to everyone for submitting all your questions. They're really interesting and I enjoy answering them. Of course, if you have any questions or feedback, send it to me at questions@investopoly.com.au. Leave a rating or share the podcast, as I said at the beginning. That'd be great. And until tomorrow, bye for now.